Welcome to Learning Plan 5. This unit will be looking at using Excel as a tool for budgeting. In industry, you may have a software package to help you with budgeting, but much of industry still prefers to use Excel due to the cost savings over purchasing a specialized software package. Budgeting can be challenging to keep track of because a lot of data is going to be interrelated. Your balance sheet accounts will drive your net income results. Your income will flow into your balance sheet through retained earnings. And cash collections are not always straightforward. You might take a sale and collect the related cash months later. The key to creating a budget is to understanding just how your business flows. So let's take a minute and learn about our example business and the unique items that Ranger Industries has. So just taking a look at Ranger Industries and the data selection that we have been provided, Ranger looks to be a merchandiser who purchases units for resale. And we're giving units of sale, okay, and we're also given an ending balance sheet for June 30th. Some interesting tidbits on Ranger Industries is that collections from customers seem to be delayed. If we look down here, looks like after we make a sale, in the month of the sale, we'll collect 20%. The month after the sale, we'll collect 50%, and then 2 months after the sale, we'll collect the remaining 30%. The other interesting factor for Ranger is that for inventory purchases, the bills are paid in the month following the purchase. So we will keep those factors in mind while preparing our sales budget, our units purchase budget, cash budget, and forecasted income statement and balance sheet for the upcoming quarter following June 30th. To start out with, let's take a look at our sales budget. So all of the data that we need is going to be up here, and what we'll be filling in today is below. So we're going to first take a look at the sales budget. And one thing to just point out about this particular example spreadsheet is we'll be filling in for July, and then August and September already have formulas built in there to flow in, just to save us time in our example. For your independent homework, you won't have these pre-built in formulas. Okay, so for July, we're looking for the number of units. So the number of units in July we can find above in our data. So I'll go ahead and start my formula. So actual budgeted unit sales for July, we're looking for cell B11. As you can see, then our pre-filled cells did fill in for us. Okay, so when it comes to dollars, we're going to take a look at our units and multiply against our unit selling price. So I'm going to build my formula equals, and I'm going to grab my units above, and I'm going to go ahead and multiply times B28, which is the average selling price. Okay, so we're hoping to have sales revenue in the month of July of $313,600. Moving on to the unit purchases budget, it's helpful to know what dollar amount of purchases we're going to be experiencing. Above, they let us know that the desired ending inventory is 40% times the next month's sales. Okay, so the desired ending inventory up here is 40% of the next month's sales. So when I move down here to my units purchase budget, okay, I'm going to take my next month's sales, which I can find right up here in August, and I'm going to multiply that times 40%. Okay? Now, when it comes to the current month unit sales, Okay, we actually have that above in cell B44 for the 1600. So my total units needed would simply be adding the two cells above, being B50 and B51. Do a sum formula there. Moving on to the beginning inventory. So up above, they gave me a beginning inventory in cell B19. This is my merchandise inventory. Okay, and actually what I'm looking for is the units, the 640 units, but they're giving it to me in the format of the units times the average cost per unit. So since I want to use formulas here, I'm going to go ahead and type in my formula as equals B19 divided by my average cost per unit, which is B29. Get that same 640. Okay. Units to purchase, I would have to subtract my total units needed from my beginning inventory. Okay, so let's go ahead and do that. If I need 2,160 units, but I have 640, how many do I have to buy? I have to buy 1,520 additional units. Okay, and if I want to know the dollar amount of how much that's going to cost, I'm going to take those units I need to purchase and multiply them by that average purchase cost per unit. So I can see that we can anticipate spending $167,200 in order to keep our inventory up to the desired level. So let's see how this cash in from revenues and cash out for purchases is going to flow into our cash budget. Now, if you remember, our cash collections on revenues are a bit delayed, so when we are building our formulas next, we're going to have to factor this in. So let's scroll down here and take a look at this cash budget. So we can see collections from customers. We've got it fanned out here. We're in the month of July, and we want to figure out what are we collecting in July from our May sales, our June sales, and our July sales. So if we remember from above, we've got some estimates here that we assume that in the month of the sale we collect 20%, the month following the sale 50%, and 2 months after the sale 30%. So if we had a sale in May, okay, and it's now July, we would build our formula as follows. Okay, we're going to take B9, we're going to go up and grab our May sales. Okay, those are the units. So we're going to multiply that by our average selling price, B28. And then we're going to apply our factor. This is 2 months. July is 2 months after May. So 2 months after the sale, we're expecting to collect in cash 30% of those sales. Okay, and now we can keep going and also calculate for June. Go up and grab our June sale, our unit sales, multiply by our average selling price, okay, times, now we're only the month after the sale, so June sales, collecting 1 month later in July, we're going to collect 50% of those. And then here's our July sales collected in July. So we'll go up, grab our July sales, times our average selling price, times the 20% that we collect in the month of the actual sale. Then we've got one more here in August just to take a look at. So if it was a sale in June, go up and grab our June sales times our average selling price, okay, times 2 months to collect. So you can see same thought process, but you're just comparing the June to August in this case versus June to July. Moving on to cash disbursements. Now remember, we're looking at a month delay. Okay, so here we have our merchandise cash disbursement. Merchandise for July is simply your accounts payable on June 30th, since it is paid in the following month. So here we'll put in our formula. We're going to go up and find our accounts payable. Here we go. Bring that down. Your variable expense, up here we can see the variable expenses are calculated at 25% of sales. Okay? So for our variable expense, we can go ahead and grab our sales, which we have computed up above for July, and multiply that times 25%. And then lastly, we've got fixed expenses, which they've given to us. So we'll go ahead and grab cell, let's see, B38, which is our fixed expenses per month. And now we've finished what has to do with our sales budget, our units purchase budget, and our cash budget. And let's just scroll down here and just take a second to notice that our ending cash balance should always be our beginning cash balance the next month. And I think that makes sense. So we ended July with 8,000 cash balance, and that will flow up here to our ending balance the next month. Okay? And so forth. So we've kind of got the basis of what now is going to flow into our forecasted income statement and balance sheet. So we'll begin first with our forecasted income statement. We've done a lot of the work above, so let's go ahead and start with sales. So for sales, we can simply sum all the sales dollars that we've calculated above here in row 46. So I'm going to go ahead and type in my sum. And I'm going to take, because we're doing for the quarter, July, August, and September. Now, cost of goods sold, we can go ahead and sum the units up in row 44. We can just see that at the top of our screen. But we're also going to want to multiply that by the amount that we paid for those units. So let's go up and find that up in our data. Average purchase cost per unit. And then gross profit, if you remember, is simply your sales minus your costs of goods sold. So let's go ahead and subtract our cost of goods sold from our sales. Variable expenses, we were just working with those. Again, we can just sum from above. Type in my sum formula. We've got row 71. Fixed expenses, same summing formula will work, but now we're going to be looking at row 72. Depreciation expense, that was given to us above for, I believe, just 1 month. So let's go ahead and take a look at our data. Depreciation per month. So we can grab that. We'll multiply it by 3 because we're looking at a whole quarter. Okay, so interest expense, we can again take a look at an entire row. We've got interest paid here, and we didn't calculate this one, but this one was calculated for us. But same concept, we're going to take the sum of the entire row. Which is going to come to our total expenses, and the spreadsheet's already working for us. Calculating our net income. If we double click on that, we can see it's taking our sales, it's like our gross profit here, and subtracting out the expenses. All right, so we've got our forecasted income for the quarter, so for 3 months, of $40,200. Let's move on to our forecasted balance sheet. We're almost to the end, so let's start with cash here. When you're working on a balance sheet, different than your income statement, which is the change statement where we're adding up 3 months, when you're dealing with a balance sheet, it's just what is the balance as of that date, okay? So cash is a great example. Your ending cash in a cash budget will be your balance sheet cash as of September 30th, okay? So let's just go up and grab cell D82. So your cash ending balance, we're in column D, because this is September. If we scroll up, we can see we're in September. Let's go ahead and drop that in. Now, accounts receivable is a little bit more complicated because remember, we need to report here the amount of revenues that we are owed, but we have not yet received, okay? So that's actually going to be factoring in 2 different months. So let's get our formula started here. So let's start with, I'm going to scroll up here. Let's start with September. So if we had sales in September of $294,000, some of those we would have collected in the month of September. I believe that was 20%. Okay, but there's 2 more periods that we have to factor in here. Okay, so I'm going to go ahead and start my formula with my D46 with my September sales. Okay, and what I would not have collected yet, I'm going to multiply, would be both what I normally would collect in the month after the sale, okay, and what I would normally collect 2 months after the sale. So I'm going to close my parentheses here. And I need another parentheses to close that entire thought. Okay? But I'm also going to have some uncollected sales from August too, aren't I? So let's keep going here. And I'm going to grab August sales. So I'm going to start a new parentheses. Okay? And what I wouldn't have collected from August yet would be the 2 months after the sale category. Okay, so I can just say times 30% of that I would not have collected yet. Close my parentheses. So there I've captured The sales I've made, but I've not yet received, which in this case was $317,520. Now, merchandise inventory for the end of September, we can go ahead and take a look. We're going to scroll up. Desired ending inventory for September. So let's go ahead and start our formula. Go back up to our D50. Okay. Then we're going to multiply that, because this is in units, by our average purchase cost per unit. Okay. And moving on to fixed assets. Fixed assets, we have a beginning fixed asset value, and then we also have what we have expensed in depreciation. Okay. So let's start our formula out here. Go way up to the top. Here's our beginning fixed assets as of June 30th. Okay. And we're going to go ahead and subtract our depreciation, which we were calculating on our income statement. So this is for the entire quarter or 3 months. So we will subtract that out. To leave us with total assets of $507,600. Okay, so accounts payable. This, remember, whatever we would go ahead and purchase in 1 month, we have a month delay to pay that. So we can simply go up take a look at what our purchases were for September. And that's what we would owe, because we're not going to pay it until the following month. All right, we've got one formula to go here, which is owner's equity, which equals your beginning owner's equity plus your net income minus dividends. So in this case, we didn't pay any dividends, but we can go ahead and grab our beginning owner's equity, okay, which was B24. And then we can add in the net income that we have in our projected or our forecasted income statement. And voila, our total liabilities and equity equals our total assets, $507,600. So isn't it interesting to see how all of these schedules are interrelated? Budgeting, though overwhelming at first, was one of my favorite tasks to complete while out in the industry, budgeting for a $700 million company. That company netted over $4 million in revenues, and I simply used a tool like Excel to budget a business of that size. So this concludes Learning Plan 5, and thank you for joining me today.